world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. This week we're joined by Husayn Kassai, founder and CEO of Onfido, and Christian Faes, founder and CEO of LendInvest. Onfido uses machine learning in customer authentication, validating users' identity documents and comparing them with facial biometrics. LendInvest is a property lending and investment platform which has originated over £1 billion of loans since launch. Both companies are regularly named among the top European fintechs and show no signs of slowing down. As always, connect with us on Twitter, Facebook, LinkedIn, or on our website at bankingthefuture.com. If you like today's show, please subscribe on iTunes or your podcast platform of choice and leave us a review. Thank you very much for joining us today. Please welcome Husayn Kassai and Christian Faes. Husayn and Christian, welcome to Rebank.
Good to be here.
Yeah, thanks for having us.
So this is the first time we've caught up with both of you. So maybe for context as we get started, Husayn, if you want to go first, one, so people recognize your voice, and two, so people know where you're coming from. Maybe you want to introduce yourself and tell us a bit about Onfido.
Of course. So I am one of the three co-founders and also the CEO. We set up the company 6 years ago after having graduated. And our main driver was that we could see that businesses are moving online, and yet the people that they're onboarding are being onboarded in a digital way, and there's no face-to-face interaction. And yet these businesses need to verify that their customers are who they claim to be. So our focus has been around building government identity verification tools and facial biometrics. We've been doing so using machine learning in particular and working with many of the fintech companies out there, especially the likes of LendInvest.
Mm-hmm. Is there a human intervention in your process, or is it exclusively software?
There is. So if you assume that you are a LendInvest consumer or an investor and you're signing up, then as part of the onboarding journey, you take a photo of your government ID and a recording of your face. And then on the back end, our machine learning models are determining if this seems legitimate or not. And then there are two scenarios where a human would get involved. One is if we suspect it's fraudulent, but we're not sure, the human gets involved to ensure that we are confident, and that lowers false positives, so to speak. And the second is if we are verifying an ID that we've not seen before. So it's a new version of a Mongolian driving license, for instance. Because we want to maximize pass rates, again, that would be done by a human. But at all times, our models are being trained so that over time, we'd recognize that new pattern, for instance.
Excellent. Christian?
Yeah, sure. So LendInvest is a marketplace platform for property finance and investing. And as a marketplace, there's obviously two sides to what we do. On the borrower side, we are positioned as basically a one-stop shop for property entrepreneurs. So we lend to borrowers that are actively buying and selling real estate or developing small real estate projects. So we don't lend to borrowers where they live in the property, so we're not a home loan lender yet, but we do have an eye on that market. And then on the investor side, we allow investors, a whole range of investors to invest in the loans that we originate from retail investors that can invest through a retail bond that we listed on the London Stock Exchange, through to high net worth and sophisticated investors can go online and select the loans that they want to invest in and essentially curate their own portfolio, through to sort of large institutional investors like Citibank and so on. And essentially we're working to bring technology to the mortgage market, which is one of the most outdated areas of financial services.
Excellent. So you mentioned you have your eye on the mortgage lending market. Do you think that's a likely future possibility?
Yeah, definitely it is. I mean, I think for us, it's really about trying to get capital which is cheap enough to have a competitive product in the market. We're conscious of not being a subprime lender, so that's a journey that we're on. We started in sort of the specialist area of short-term mortgages where you get sort of a higher return. As we've scaled our business, we've been able to move quite successfully into buy-to-let as a product, which with a rate of like 2.99 for 2 years fixed. So our cost of capital is slowly getting cheap enough to the point where we'll be able to offer a fairly attractive home loan. But we think it has to be priced effectively. No matter how good the consumer online experience is, someone's not going to pay more for their home loan just for it to be online.
Yep. Do you do bridging finance also, or is it primarily term lending?
No, we do bridging as well. Yeah, so we lend from 1 month through to 30 years in duration. Bridging is where we started as a business, and it's kind of it's a great market, but it's not hugely scalable. We're already sort of 15% of that market.
Okay, so a topic of the day, I suppose, the onboarding journey. So in a digital-only environment for a new customer. Obviously, Onfido, that's what you guys are working on. I mean, Christian, maybe we can start with you. So I think you guys recently started working with Husayn.
We did,
Onfido, right?
Yeah. Yep.
How long ago was that?
I think it was probably a couple of months, but went live only recently, probably in recent weeks.
Yeah. So what was the journey like for a customer onboarding journey prior to Onfido, and how, if at all, has it changed, or do you expect it to?
It's changed dramatically, and I think we're probably a good example of, we are constantly trying to improve the consumer experience. The average mortgage in the UK takes 3 months, so it's just like a woefully long, paper-intensive, sort of ridiculous experience for consumers. Even on the buy-to-let side, it's extremely slow. So in the buy-to-let side of things, for example, a borrower would typically go through their mortgage broker, and they would have to get things like their passport, proof of address certified by a solicitor, and then provide them to our solicitor, who would then sort of provide them to our office. So there was a huge amount of paperwork and scanning of documents and emails flying around just to sort of verify who a borrower is and to sort of perform these regulatory checks. Now they get sent a link and they open up their smartphone and they take a photo of their passport and they take a selfie, and that verification is done through the Onfido platform in a fairly automated way, or an entirely automated way. So it's taken a process that best case scenario took days and wasn't particularly attractive or an easy one for a borrower, through to one now that's actually quite novel. I think the early feedback we've had from the brokers, who are not necessarily the most digitally dynamic sort of subset of users, in a very broad generalization. But the early feedback is that they all love it. It's super easy, it's super quick, and it's come across very, very well.
So Husayn, I'd be interested in the. You mentioned you started the company 6 years ago. Well before I don't know, maybe Jumio was around back then, but well before these like fully automated, fully digital onboarding processes were kind of were prevalent. But even before presumably banks and regulators would even really look at them. What was that experience like earlier on in terms of engaging with banks, engaging with regulators, and getting people comfortable with a digital-only onboarding process?
So the most part was to get over this misconception, or maybe an outdated view, that the human eye naturally is the best form of verification. So back to Christian's example, what we're substituting for is the need to go and see a human solicitor, and that with a human eye, they'll check your government ID and check that your face is consistent with that photo on the government's ID. Well, scientifically, it's been proven numerous times what machine learning powered technology does a better job of detecting facial recognition and comparing two faces. We as humans aren't necessarily naturally good at that. There are some who are better than others, but it's mostly a case of with training you don't necessarily get better, whereas again, machine learning is the way to do it. So that we were, I guess, focused on showing that not only is it much more convenient to do it at home or from the convenience of you're just using your camera phone, but it's also more secure. So that's been, I guess, the main parts of it, and it's given that it can scientifically be proven, what we do with banks or fintechs or even non-regulated clients would be to tell them, throw 1,000 IDs and facial biometrics through our system and do the same in a human journey method, and then compare the difference between fakes and sort of speed and all the rest of it so that you can see the results. And prior to that, I suppose, for me, my journey started when I was 10. My parents moved from Iran to the UK, and it just took them 4 months to be able to open a bank account and to be able to rent in their own name, just because they weren't on a credit bureau. So I could kind of see growing up that the way we as consumers are verifying ourselves, it's either very paper-based and cumbersome and slow, or you're completely excluded because you don't have a credit footprint. And that naturally, given that technology now exists to be able to verify individuals in a more secure way and convenient, it just seemed as though it'd be the next big thing. And that's why with my two co-founders, we started to work on it back in 2012.
Yeah. How do those 1,000 document tests usually go?
So we're doing particularly well, and we tell clients that tell us what success looks like for you from the outset, and then test our system. And you need some sort of benchmark to test us against. So you mentioned Jumio, they started at 2012 as well. So it's a case of compare us to internal manual human processes or alternatives, and then I guess you can make an informed decision.
Yeah.
Where we tend to win those pilots, so to speak. Where we originally or initially didn't do as well was when, frustratingly, the clients didn't have a sample set to test with. So it'd be a case of like taking our word for it versus others. But now we've got established use case examples.
Does it tend to be more powerful in kind of flagging negatives or reducing false positives, or both?
You could imagine whereby, because we have the ability whereby if an ID comes through, say a German passport, if it's stained, we don't know if it's because it's went through a washing machine, or if it's from a sophisticated fraudster. So when that happens, we flag it, and then we have a human agent double checking. And when a human agent double checks, that reduces the likelihood of a false positive going through. The signal that the client receives, the business, is also whether it's a caution or a warning. A caution could be, this document is expired, or it's black and white, whereas a warning is, we have evidence that suggests this is fraudulent. So the business, the client, also would have an underwriting team that would double check as well. So you have a scenario where we're double checking and they're double checking too. And the benefits of that is that traditionally businesses would, of every 100 individuals who'd sign up, they'd have to manually check everything. Whereas with our tools, they'd only have to double check 3 to 5 or so on average. And it can have more skilled individuals and devote more time to those 3 to 5.
I'd be curious, apart from the UK, where else do you guys operate? Like, what are your main markets?
Our largest market is actually the US.
Okay.
So the UK is second. We have quite a long tail. So we did a press release just last week around Zoomcar, the largest peer-to-peer car rental sort of platform out in India. Lending cards is another instance. So we have, from our team, we're headquartered in London, but we have a large team out in the US, 4 in India, and now 1 in Singapore. So we're 170 in total.
Okay. And you do banking clients or regulated clients in the US too?
The majority of our clients are regulated.
Yeah.
And so we power a little over 1,500 businesses. Of those, 75% are regulated.
Okay.
And the others are trust marketplaces, so home sharing, car sharing, Zipcar, and those use cases.
Well, I was hoping that you would answer in the affirmative with respect to the US, so I could ask this, no doubt, very dull, but I think very important question. Having gone through a banking license application process here in the UK successfully, thankfully, and dealt with the principles-based approach to regulation, i.e. the regulator kind of sets out high level what should happen, how things need to look, but then it's really the outcomes afterwards which are kind of the results of your correct implementation of what you should have done. They're not prescriptive in telling you exactly what a process has to look like, barring, I suppose, a few elements maybe, whereas the US is much more rules-based. From those two different regulatory approaches, is there a different kind of willingness or ability for customers to engage a cutting-edge tech-based compliance tool like Onfido?
So both models have their advantages, I guess. So we have, it's been accepted as a regulated method pretty much globally. Germany is an exception, and there are a few pockets of exception.
They require the video kind of onboarding
unfortunately,
still.
it's very much, you have to have a face-to-face interaction, even if it's on a Skype call or a similar platform. Whereas in the US, having the rule-based, it can, from a compliance manager, all I would want, for instance, is I tick these boxes and I'm good to go, and the regulators can't come after me. However, the advantage of having broader guidelines and allowing some discretion over how a business deems, from a risk-based approach, how they comply, is that they could use different tools, and they could use the more innovative tools to be able to see what the options are or how something can be solved for. So the consensus across the globe is credit bureaus historically have underpinned the financial services. So if it's in a digital setting, you having been verified at a bank 6 months ago, they've logged your date of birth, name and address, and now you want to go onto another banking platform, they would ping that credit bureau and see if your date of birth, name and address exists. Mm-hmm. The problem with that is that it's kind of lost its currency, given that you have these breaches. So the vast majority of us, our data is now on the dark web. So I could very easily pretend to be you, steal your date of birth, name and address, and essentially commit identity fraud. And that's the issue with the identity fraud problem being the largest crime in the US and the fastest growing crime in the US. So there's a growing consensus in most regulated businesses moving away from the credit bureau model and towards a stronger verification tool. When you're moving and considering alternatives to stronger verification, showing a government ID and facial biometrics or similar seems to be the right balance between happy friction and yet secure at the same time. So that's why so many businesses are taking this approach.
Mm-hmm. So one of the things I wanted to pick up, there's been a lot of news lately, or rather 3 massive news outlets, the Financial Times, I believe Reuters, and Bloomberg, all picking up on a story. So Revolut submitted basically like a suspected money laundering report to the FCA in the UK, and the media backlash around that was, while they're scaling too fast, they can't properly onboard and monitor customers across their business. Like, this is a big red flag. We need to be concerned about this. Christian, you have a large business. Husayn, you're working day in and day out with fintechs, with banks on topics just like this. What are your views in terms of this concept that fintechs that are scaling too aggressively are exposing themselves to money laundering, shortcomings in onboarding, and putting the system at risk?
I mean, I saw the media reports, and I don't know the specifics of the situation, but I'm sure any large financial services organization makes reports to the FCA on various instances of potential breaches around AML. So I think the fact that they latched onto that, or the press sort of positioned that as perhaps some fintechs have grown too quickly, I think it's kind of it's showing there is a lot of skepticism around fintech, and certainly that comes from traditional financial services in many respects, and obviously the publications that sort of talk to that audience more regularly. So I think I don't think it's fair to say it's a reflection of businesses growing too quickly. Is my view of it.
Yeah, it seems as though if the logic is that just because a fintech is growing rapidly, by definition, or you could draw a conclusion to say they are unlikely to be as compliant. That's kind of the old way of thinking, in that there's no reason why, be it the UK, US, or across many other countries, these fintechs have been able to show that in a lean way, they're able to be compliant, but using fewer resources, but technologically advanced resources. And the signal or the proof point in that is that the banks themselves, the mainstream banks, are adopting and copying the fintech models, and especially the online banks. So pretty much almost, you could say, even up to 3 years ago, the mainstream banks didn't take these online banks seriously. They thought, how can you have an online bank? You're going to get all the fraudsters going there. But over the last year and two, for instance, the mainstream banks have been able to see that these online banks aren't just able to scale as effectively, but on average, their risk and fraud profiles tend to be lower than even the mainstream banks. And that's what's, I guess, created the shift. And you can see that by mainstream banks buying these online banks or spinning up a digital online bank themselves. And that is fundamentally showing that sophisticated technology could be used to determine if a fraudster is likely to be a fraudster more than a human bank clerk would in a bank branch. In parallel to that, you have a problem on a global scale that fraud is just increasing. It used to be quoted that 2 to 5% of the world GDP is laundered money. Now figures of around 8% are being quoted as being laundered money, and that's used for illicit funds, human trafficking, drug trafficking, terrorist financing, really awful things. So on the one hand, what options do the regulators have? They can't do much. All they can really do is increase fines for businesses. But on the other hand, businesses themselves, the historic traditional response has been to increase the barriers for people being onboarded. Well, that's how you can get a 40% drop-off rate, and that's why it's becoming more difficult for consumers to sign up. So you can have a happy middle ground where you're increasing security and increasing conversion or onboarding at the same time, and you can really only get there by using machine learning-based technology. So it can be a CIF science on behavioral stuff, it could be a Comply Advantage on watch lists, it could be our verification and onboarding tools. So it's the reason why these regtechs, quote unquote, are being adopted so much is because they're getting the balance right between helping conversion and helping onboarding of customers be a smooth experience while reducing fraud at the same time, and helping banks and other financial services learn from the fraudulent attempts that have occurred through individuals or fraudsters at other banks too.
Mm-hmm. Well, you mentioned growing market share of fintechs, and I suppose on a still regular basis, you get the report out saying, well, neobanks really haven't converted as many customers as people thought, and on and on. Courts recently published an article which our friend Lex at Autonomous Next picked up, which we'll link to in the show notes, about how now something like 36% of consumer lending in the U.S. is done by fintechs. There's currently $120 billion of unsecured personal loans outstanding, mostly originated, 36% of which originated through fintechs, which is firstly phenomenal. Like I had no idea there was that much volume being originated by fintechs. Christian, you're there. I mean, there's clearly appetite in alternative sources of funding. I guess the skeptic might say that people are always happy to borrow money. They don't care where it comes from. Maybe part of it is that it's a smooth journey, so it's just easier. Maybe the fact is, I don't know, through the use of technology or other means, simply looser credit appetites, not having gone through a full business cycle. People are lending money, i.e. fintechs are lending money in situations in which incumbents might not. Do you have a view?
Yeah. I think credit has probably become easier in the sense that the experience is easier. So you can go online, you can go through certain apps. I remember being at a lunch once when, sort of last year when there was the whole crypto craze and someone went on to a peer-to-peer website, got instant cash and then sort of invested in Bitcoin. And I think, that
was it your platform?
It wasn't our platform, definitely not. But, I think it was quite an interesting demonstration of just perhaps how easy it is. And this person, had a few drinks and all the rest of it. So, who knows whether that was appropriate or not. I'd say maybe not. But I think the experience has become easier. But I think that stat, in many respects, probably just reflects the digitization of everything, from takeaway food to getting a taxi or whatever. I mean, I think the reality is, you look at big banks that you would think are traditional financial services businesses like Goldman Sachs and their Marcus platform in the US, which is lending a huge amount of money.
That's a good point. I wonder if that captures Marcus.
I'm sure it does. That's fintech. That's a digital platform, probably Quicken Loans and a whole bunch of other sort of more mainstream-ish financial services businesses that would be captured by that. And I think that's just a reality of finance going online, as much as it is sort of any reflection of irresponsible lending.
Yeah. Well, I mean, it should be noted that that figure is higher than the pre-financial crisis figure of consumer debt, which suggests that, I suppose, lending appetite by companies and borrowing appetite by consumers has not only returned to but indeed exceeded pre-financial crisis levels, which is a bit scary.
Yeah, potentially, but I don't know if that's that. I don't think fintech has been a contributor to that.
It's kind of interesting it will be very interesting to watch how some of the newer kind of behavioral based credit underwriting models, i.e., for instance, a lot of people are leveraging open banking and data availability to look at transaction histories and extrapolate behaviors and credit worthiness based on behaviors as opposed to the traditional credit score. And the purpose, of course, is that works much better and that you can gain much better insights. And I have no doubt that that's true. I guess the question, which may eventually be answered, is are we there yet in terms of appropriately judging creditworthiness based on new data sources that haven't necessarily been tested through the cycle?
I think the big issue is that the credit reference agencies really only know people who kind of exist and have a track record here. So, Husayn talks about his parents' experience of moving here. I was an immigrant. I moved here as well. When you've got no credit file, it's very difficult to get even a bank account, let alone a credit card. So I think some of the behavioral stuff, business like Air and startups that are working on that stuff, I think are making a really valuable contribution to society. Actually, it doesn't, just because you don't have a credit file doesn't mean that perhaps you're not going to be a good borrower and shouldn't be given the opportunity to have some finance. The extent of that finance and so on, I guess, is up to the individual lending companies that are making loans. But I think that there'll be big advances in that space.
Mm-hmm. Another one for you, Christian. The FCA published a report on the P2P, peer-to-peer lending market. Yes. And they sounds like largely exonerated the investment marketplaces, but had some concerns about the lending platforms in terms of mostly, I think, clarity of terms and conditions and risks that borrowers. Not borrowers, I suppose the lenders were facing. It sounds like, broadly speaking, that kind of touches your space. You guys are clearly squarely in property, and I think you said working with accredited investors. But thoughts on that report? Yeah,
so we're not a peer-to-peer platform, and we made the decision about a year and a half ago not to market to retail investors with our online platform. And I think in some respects that report from the FCA validates that decision in the sense that it seems pretty clear that the FCA has some concerns around sort of platforms that are actively targeting retail investors in the peer-to-peer space. And so I think, we're going to see a regulatory clampdown, which is probably a sensible thing. I think it caught some people off guard in the sense that the FCA made very clear signals that they were quite happy, like you say, with the equity crowdfunding side of things, where people probably perceive that as being the highest risk, but they were more concerned about the peer-to-peer side. And I think in some respects that's right in that people that invest in the equity crowdfunding platform probably or hopefully understand that they may not, get their money back, or it's kind of an investment, so it's a longer term proposition. I think with peer-to-peer that people are expecting to get their money back and to get a return on that money. It's a nascent industry in many respects, and there's been platforms that have no real credit experience set up, and they're taking retail money and lending it out. So I think things will go wrong at some stage, but that's just all part of the industry maturing.
Yeah. Well, Husayn, last question to you as we wrap up. You talked us through kind of your to an extent your journey over the past 6 years and where the industry has gone over that period of time. You mentioned some other quote unquote reg tech startups, Comply Advantage and others. In your view, where are we? How far along are we in the compliance, AML, KYC, onboarding, ID&V space in terms of automation, applying software, applying technology, applying machine learning? How far are we, and how far can we go?
So very, very early stages, probably. McKinsey ran a report about the digital identity verification market and how it's just at the very early stages. And it's very early because it's very early for the fintech scene. Because as RegTechs, we're in many ways helping fintechs as well as mainstream banks become or remain compliant, but in a lean way. And that is also relevant, I guess, in part to your previous question around the rise of peer-to-peer lending more broadly. It's in many ways, consumers are benefiting as long as it's regulated properly. Because if you rewind 300 years, we used to have lords or landlords who held the majority of the power. And then over the last 100 or 200 years, it's been manufacturers and factory owners and so on. But in the last few decades, it's been financiers, and it's been a concentration of power in the banking sector in particular. Whereas what these fintechs are doing, and what the peer-to-peer lenders and other peer-to-peer networks are doing, is in many ways creating competition and helping borrowers connect with savers and investors or different applications, but in a much more distributed sense. And that drives better rates, better availability, and it now becomes possible. If historically you may not have been able to take out a loan, you might now be able to. So subject to you being compliant, consumers can gain access to all these financial services while being protected from potential malpractice. So on that journey, it's still very, very early days. Although the stats on the States seem like a large amount, pretty soon, hopefully in 3 or 4 years, we'll think, why would ever anyone still be with a traditional method of borrowing? And as long as that journey is still in its very early stages, in my view, we have a long way to go in terms of RegTech's contribution to ensuring that the customer experience is always front and center and is always smooth and slick. And at the same time, there's no compromise on fraud or compliance more broadly.
Should the UK government or the US government offer digital identity?
Government has a role of issuing identity, and they should continue to do that. As for the enabling a shared identity system, it's been done. We have India, Estonia, quite a few countries. The challenge with having a centralized database method is kind of like a credit bureau model, but for the public sector, and that any centralized database is susceptible to being breached, and therefore the whole digital identity ecosystem loses its currency if it's been breached, as we've heard in India more recently, even in Estonia model, in Turkey, and all these different models. So the government's best role is to issue government identities to everyone, and a 1% increase in financial inclusion leads to a 3.6% increase in GDP. So across emerging markets, almost everyone, every country has a plan and a program for it. There are still 1.1 billion people without any sort of government identification, and as part of the United Nations Sustainable Development Plan to ensure that everyone has that by 2025. But the answer to your question is, it's great when the government has a role of ensuring everyone has a form of identification. Our preferred method is a decentralized approach whereby the government doesn't centralize a digital sharing ecosystem.
Yeah. I'd just add that I'm super bullish on businesses like Onfido and sort of the whole RegTech space, because I think you look at the kind of the unbundling of financial services, and you have businesses like ours where we're super focused on being experts in property lending. But to be a serious financial services business, you've got to do the AML and the KYC stuff extremely well, and it's critical to the business, but it's not a focus of ours. So if we can plug into a platform like Onfido and then sort of get back to what we do, then that is what that's great for our business. So I think you see that across the fintech landscape. And then you also see the big banks as well, the kind of sort of very slow incumbents that no doubt will leverage off platforms like that as well. So I think the future's bright.
Excellent. Well, Husayn Kassai of Onfido and Christian Faes of LendInvest, thank you very much for joining us today.
Thanks.
To be on.
Cheers.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.